Good morning. Welcome to ICG Enterprise Trust's Q1 trading update for the 3 months to 30th of April 2024. I'm joined today by Oliver Gardy and Colin Walsh, who will discuss our investment performance and activity in more detail over the course of the presentation. The slides for the presentation, along with the accompanying results announcement, are available on our website. We will have time for Q&A at the end of the presentation, so if you would like to submit a question, please do so through the online portal at any point in the Q&A box on your screens. We will then aim to answer these questions at the end of the session. With that, Oliver, over to you.
Thanks, Martin. I thought we'll give you a little bit more of a perspective on the market as well as on ICGT before Colin dives into the numbers. It has been another quarter where our clear investment strategy, focusing on defensive growth, has performed well. Our portfolio grew 1.3% on a sterling basis over the 3 months to April 30th, 2024. The exit activity continues to be executed at an uplift to carrying value, and Colin will share some numbers there, which continues our long-standing trend. We also communicated to you in our full year results in May that we expect a measured increase in transaction volumes in the coming quarter. We continue with that view. Nothing changes. We continue to expect a measured increase in the coming quarters. All the conditions are in place for the exit environment to pick back up, as we said in our shareholder seminar as well. Our managers are focused, and the reason for that is that managers are very much focused on liquidity since they have fallen behind over the last 2 years. But probably most importantly, debt markets are better positioned than they were 12 to 24 months ago. Spreads are down, and cost of capital has tightened up in the sense of that cost of capital has reduced. And that usually causes a lot more exit activity and more aggressive buying. With that backdrop, I'll hand over to Colin.
Thanks, Oliver, and good morning, everyone. So a quick overview of the quarter in numbers. So in Q1, and that's for us the 3 months to the 30th of April 2024, our portfolio grew on a local currency basis by around 0.5%, and on a sterling basis, as Oliver mentioned, by 1.3%. That translates into NAV per share total return growth over the period of 1.2%. Our share price total return over the period was marginally down, so it fell by 0.8%. That's based on a closing share price of 12.08 on the 30th of April. As of yesterday, our share price was closed at 12.34. We're continuing our focus on all forms of shareholder distributions, and we do this through both dividends and buybacks. We're announcing a Q1 FY25 dividend we announced yesterday of 8.5 per share. And in the quarter, worth noting that we returned around 7 million to shareholders through share buybacks. Looking at activity, it was a relatively quiet quarter, but as we demonstrated a disciplined approach to investment activity, we had 28 million pounds worth of new commitments, and they were to 2 of our long-standing manager relationships in Leeds Equity and Oak Hill, 2 US-based managers with whom we've enjoyed considerable success since pivoting our strategy towards the US back in 2016. We invested 32 million in the quarter. Of that, 10% was to funds managed by ICG, and exit activity was broadly in line with new investment activity, total realization proceeds of 29 million. And within that, there were 2 full exits, and they were completed during the quarter. As Oliver noted, they were completed at a premium to previous carrying value, continuing that long-standing trend. So moving on to the next slide. And this slide builds on the numbers I've just taken you through, splits out by investment type, by primary, direct, and secondary. And yes, you can see our portfolio growth was driven by primary and direct performance. FX also moved in our favor, so that gave us an extra 0.8% on top of the portfolio return. Our closing portfolio value stands just shy of 1.4 billion pounds. About 31% of that is in ICG managed investments. So moving on to the next slide. Just, I suppose, to bring what we do and bring the numbers to some degree to life, I wanted to spend a few minutes on a recent investment. It's a business called Multiversity. As you can see from the slide, it's the #1 online higher education group in Italy, over 170,000 students participating in online education. It's what's known in the trade as a GP-led secondary, and this is where a manager, in this case CVC, one of the world's leading private equity managers, gives investors the choice they want to keep participating in the success of this company, but they want to hold it for longer. So they give investors the choice to continue to participate in the investment or to step back and take the liquidity. Now we've elected to continue to invest. It's a really good exemplar of a defensive growth company. It's a market leader, has significant barriers to entry. And critically for our approach, it's a company where we have a distinctive ICG angle, as our colleagues in our strategic equity strategy are the lead underwriter of this transaction. And that gives us really strong insights both into the company, but also into the sector. As I said, it's a really good example of the types of things we look for in a company. And it's also a great example of the power of the ICG platform, which we think is very differentiated. In terms of portfolio composition today, just to remind you that back in 2023, we announced some medium-term targets around type of investment. That's the split between primaries, directs, and secondaries. By geography, in particular, aiming to pivot to having a 50-50 allocation between the US and Europe, and also our net cash, net debt position. Just touching on a few of those, as you can see from the slide, our portfolio by investment type stands at 55% primary, 29% direct, and 16% secondary. These ebb and flow over time with new investments and realizations, so it's always very much a kind of a direction of travel. It's worth noting in terms of our secondary allocation that one of the reasons it's a little bit below our target is by virtue of its success. Its realization profile is actually ahead of our investment case, and that's meant that obviously the exposure has come down. Looking at geography, as you can see, we're pretty much in line with our 50-50 allocation. We have a small exposure, 6% to the rest of the world, but that's definitely a target which we're very, which we're in the right ballpark for. And our debt exposure at quarter end, 3% gearing. We manage our balance sheet very prudently, and we use our revolving credit facility to bridge some of the timing differences that we have between calls and distributions. So very much in line with how we tend to manage the balance sheet going forward. So with that, I'm going to hand back to Oliver, who's going to conclude and talk a little bit more about shareholder experience.
Thanks, Colin. As many of you know, our board has been very focused on shareholder distributions and has been very active in introducing buyback programs. But firstly, let's talk about the progressive dividend policy. As Colin mentioned, the board has agreed to pay 8.5p for the quarter of 2025 and is communicating a dividend for 35p for the fiscal year 2025, which represents about a 6% increase. And then secondly, we have the long-term share buyback program, which is meant to be particularly being very active in the market, constantly supporting liquidity and reducing volatility in the share price. You can see here on the slide, we've been in the market 103 days in the market and have returned 25 million back to our shareholders. This is really the long-term share buyback plan we introduced in the fall of 2022 and has worked very well, in our opinion, in terms of reducing volatility and being always a buyer out there for if there isn't enough buyers in the market to take care of the sellers. Then we introduced last month in our annual results, we introduced an opportunistic share buyback program. This is meant and designed to be taking advantage of big overhangs or buying big blocks, particularly at the current discounts where we feel that can be highly accretive to our NAV per share, to our share price and our NAV per share. And we have been already active and buying roughly 7.5 million pounds of shares back. The board has approved up to 25 million. for the fiscal year of 2025. And as you can see here, we have been already very active, which brings us to the concluding slide. In summary, our goal is to produce for our investors low to mid-teens returns and portfolio returns, as well as an NAV per share. You see here that on a 3-year basis, on a 5-year basis, we delivered that. And the way how we deliver that as foremost is the investment strategy. We are focused on buyouts, US, Europe, in defensive growth sectors and defensive growth companies. And that has really proven well to grow, and the company and the portfolio is growing well in good times and bad times. And the other 3 value drivers for us and for our shareholders is really the progressive dividend policy, the long-term share buyback, and the opportunistic share buyback, all designed to deliver long-term outperformance for our shareholders. And with that, I'd like to conclude